Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, December 14th, 4:33 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Little heads up, there will be no video next Monday and Tuesday. That is December 18th and 19th, as I'll be traveling up north to see some family and really won't have time to get to that. Looking forward to a little bit of time off, but we'll have the Friday video, we'll have the weekend podcast, and off Monday and Tuesday, and then back Wednesday the 20th. So state of the market, we're in an uptrend since the O'Neill follow-through days on November 1st and 2nd. You can see the 4 green arrows over here, pretty much indicating the health of the overall market, skewed to the positive side. Always got to be careful when things get to be a little too good, just the same as when things get a little too bad, because 3 things sure in life are death, taxes, and the market reverting to the mean. But for now, we're fine. We're extended, which is why I have the yellow caution symbols there against the short and medium term moving averages. But let's go through it, then we'll look at the charts and see where we are. So market leadership, green arrow, plenty of leadership since the follow-through days. More things coming to the fore, some possible rotation out of some things that led these last 6 weeks into some new names. We'll talk about that when we get to the charts. Short term, all 5 of the major indexes above their 21-day exponential moving average, green arrow. Also above their medium-term 50-day moving average and their long-term 200-day moving average. So green arrows there. We were extended after day 4, also after day 5, and got a gap up on day 6. That is not the time to be piling in, as we saw a reversal today. The NASDAQ 100 reversing to finish red. The S&P 500 stayed green, gave up about half of the gains, but a lot of rotation, sector rotation taking place under the hood, and this is why we're big proponents of having a core position in the S&P 500. It handles all that rotation from low beta to high beta, in between sectors, growth to value, you name it. It's all within the S&P 500, and different sectors come in and out of favor all the time. So what happened today? Post-FOMC, as I mentioned, rotation, some new leaders or some old leaders fading. We'll see. Here are the numbers on the day. The big 7, positive but just barely, would have been negative except that Tesla bucked the overall trend on the big 7, was up 4.91% today. So that took the average gain to 0.17%. RG8's what we're looking for, leadership in the growth sectors, up 2.01%. S&P 500 gapped up 0.4, was up as high as 0.7, reversed to negative, bounced in the afternoon into the close, up about 0.25%. Equal weighted, this is good news, equal weighted RSP outperformed, up 1.36%. NASDAQ 100 gapped up 0.3, went a little higher, then reversed hard, was down as much as 0.7% before rallying a bit into the close, but still finishing red. But the equal weighted QQ EW up 0.68%. That's another good sign. Dow up 0.43. Mid caps and small caps continue to dominate. Mid caps up 2.4%. Russell 2000 up 2.7%. Global diversified 60/40 stock and bond up 0.57%. Equal contributions from both broad worldwide stocks and worldwide bonds. In-house GROTECTION up 0.72%, off the highs, unfortunately, from the gap at the beginning of the day, but you know that's coming when you're already extended and you have a gap up on the 6th day. We'll take a look at the charts and flesh it all out. Let's get into it, and then the tail of the tape. So here's the S&P 500. Higher close. You can see the gap up here started to fade, and then back up near the highs failed. A really harsh move down, almost 1%, from early afternoon to, well, for about an hour and a half or so. And then slowly climbing back into the close. Last 2 pullbacks we saw now after trying to run. So got to reference these points. 46.83, the low on Wednesday afternoon after the Fed, and today's low, 46.94. So kind of a 10 10-point spread in there. That'll be a band of support that will look. So basically, let's say we don't want to break below 46.80, or we start to give up all those Fed gains. Market is trying to figure out, did it front run the Fed enough, or do we need to chase, or lots going on. And what you'll see is increased volatility from the market, kind of like when you're trickling down in a bull market or in a bear market, you're trickling lower and then you get a sharp rally and you think that everything's great, the coast is clear, and you pile in and then see those gains evaporate. You see just the opposite in a strong bull market. You tend to work your way higher slowly. That's called escalator up. And then the pullbacks are harsher, but they should be bought unless stocks or indexes start breaking key levels. So it's escalator up, elevator down, but those elevator downs are usually shorter periods of time, but they're sharp. And as I said, they're buying opportunities as long as the market doesn't start breaking or individual stocks don't start breaking. So there's the S&P 500. Let's go to the NASDAQ 100. Gapped up, finished red, but off the lows, actually in the top of the range for the day. Let's go to the 5-minute chart here. You can see the gap up, a little bit of a move higher, the same slide lower, led by the big 7 to the downside, a little bit of a rally into the close. So it's like a lower close, but after 5 strong days up, it's should be expected. Extended 7.5% from the 50-day moving average, 3.5% from the 21. My expectation is that we continue to go sideways here and let the 21-day catch up to things. Let's see how extended we are on the S&P 500, because we did bring out the caution sign. 6.8% above the 50-day moving average, 3.3% above the 21-day moving average. Definitely historically extended versus the norm. Dow Jones Industrial Average making a higher high, up 0.43%. Mid caps kind of volatile, but gapped up, held most of the gap, did give some of it back, but strong into the close. You can almost see panic buying here the first 20 minutes before giving some up, working it a little by little higher, another sharp sell-off, and then trickling higher. So this is kind of, think of this as escalator up, elevator down, escalator up. You will see sharp pullbacks, but again, this is a breakout above the 500 level, big cup breakout. Think that of this level as the handle between 480 and 485 before busting out the last 2 days. Yeah, it's pretty strong. Wouldn't be surprised to see a pullback after those 2 big up days, however. And same thing with the small caps. Ran into this 200 level, round number resistance, but here's the handle. It's clearly articulated here on pattern recognition before the 2 moves up. Again, we kind of want to see some sideways action here to see things calm down a little bit and see how leaders act, or if new leaders emerge. So those are the 5 major indexes. Let's go to the VIX. VIX actually up on the day, not a surprise. People are starting to hedge after being so extended, and the VIX trickling up a little bit. I did mention I wouldn't be surprised to see volatility tick up a little bit as we really tighten the range here. I mean, we had an 11 handle each of the last 3 days on the VIX, so that volatility normally doesn't stay that low. Again, I keep saying normal because there's a lot of is there really ever a normal market? No, but there's different types of markets. They all have their own signatures, but there are idiosyncrasies always involved. Here's the dollar, big move down on the dollar. Again, making lower lows. 2 days, we gave up 2 weeks of gains in the dollar on the pullback, and down 0.93% on the day. And if you think gold and silver stocks benefited, you would be correct. GLD up 0.59%, not making a higher high relative to 2 weeks ago. GDX touched the higher high and then reversed to close in the bottom third of the range, but still up 2%, just a little too far, too fast the last 2 days on those. That's another thing we want to see go sideways before busting above this 32 level on the GDX. And silver SLV nicely up 1.75%, continuing the move to the upside. Bitcoin, the ITO just barely positive, trickling higher after that big move down on Monday. How about bonds? Yields low, price higher, big gap up here. 0.75% on the broad bond index, TLT, the long bond up 2.27%, which means big drop in the long bond rates. There it is, breaking below the 200-day moving average back to where we were in July, and the 10-year TNX down 2.55%, also breaking the 200-day moving average back to where we were in August. So those are the major inter-asset correlations that we take a look at. Let's get to the tail of the tape here. So before the open, retail sales above expectations, jobless claims below expectations. Atlanta Fed GDP upped their forecast to 2.6% for the current quarter. So all of those things indicate a stronger economy, but the Fed is after the reaction yesterday, good news might have been bad news last week, but not anymore, as they signaled those 3 rate cuts for next year, and the market is sticking with them and then trying to decide where money is going to act best in a declining rate environment. Day count from up 5 to up 6 on the S&P, 6 days above the 80 EMA, 30 days above the 21 EMA. Nice rally. Sectors strong: semiconductors, oils, regional banks, home builders, like they were shot out of a cannon with the reduction in rates. Gold, and silver stocks, and real estate on the downside. Adobe had a bad reaction to earnings that hit the software sector. XLK, Microsoft down 2.25%. That was really the big impact on that. And then some defensive sectors. If we're not going into recession, do you need to hunker down in staples? Not necessarily. XLP down 1.5%, utilities down 1.3% after a big move up yesterday, and XLV Medical's down. As far as the portfolio goes, on the gap up this morning, we did some offensive selling on FNGU. That's the big 7 plus 3, and Nail. That last piece of Nail, we got a 50% gain out of. Just kind of amazing. The S&P was up 3% during the time that Nail was up 50%. So this is why we play these leveraged ETFs, when you catch them at the right time with the right stop and let them run, trim some into strength. We took gains at 20%, 24%, 28%, and now 50% on the 4 1% tranches that we had there. Looking for some new things to emerge, we bought LYV and NRGU added to ESTC. So some of the leaders that we're building positions in continue to hold up well. We're looking at pulling back. They bounce off the 8 EMA. If they break the 8 EMA, we'll reduce, and we'll go over the charts, and I'll talk about this in a minute. So basically about the same exposure, 1.77 to 1.79. Bottom line, post-FOMC sector rotation. Are we looking for new leadership? Let's take a look at some charts and see. And let me start off with, first I'm going to start off with a couple of leaders that did not have strong days today. And then the question is this a normal pullback for them, or is money coming out of them and they need to build a base and it's time to move on to some other things? And we're going to start off with something I mentioned in the title of this. Beware of this pattern, and this pattern is DraftKings. DraftKings was a leading stock, broke out, acting fine. Nice gap up on earnings, trailing the 8 EMA. Then it paused around the 8 EMA on lower volume, not a problem. And then we started seeing a couple days of selling on average or above average volume, 3 in a row here, where we broke the 8, then we broke the 21. Didn't go down any further, and then we started wedging. 4 up days got us back above the 21 and the 8, but look at the volume on those 4 days compared to the big signature volume on the 3 days that we were selling off. And then a gap up today along with the market was sold with 2 hands. You can see 3 clear waves down, no buyers in DraftKings today. So this is just something where a former leader may not continue to be one of the leaders going forward. You can see the relative strength lagging also. And not something I want to be involved in now with 4 big distribution days out of the last 2 weeks. It's there's clearly better opportunity. So DraftKings did not work today in that wedge pattern. Always keep an eye on that. Where you have selling, you think, oh, it's not that bad when it starts to recover, but the recovery is nowhere near on the volume that the selling took place in. You could take that back another week and see another above average selling day, a couple of them, but the up days, granted, this was Thanksgiving in here, but the up day, very light volume, and then just really not making progress. Relative strength starts to lag a little bit, and then you get the big negative reversal today. So we're done with DraftKings. A couple others that have been very strong leaders but had negative reversals today. GoDaddy, all it did is bounce at the ADMA, first touch of the ADMA. But beware if it breaks today's lows, because it could free fall quickly down to the 21-day exponential moving average. Wing, same situation, undercut the 8, didn't quite get back above it, but you can see the length of this candle, or the width of this candle, is a lot more volatile than all of these leading up into it. So a little bit of a change in character on that today, and the selling was on above average volume. Decker's, another leader, got up to that 700 level. Negative reversal today, above average volume, above any of the 5, 6, 7 prior up candles. And closed right on the 8 EMA. So below today's low, it may, and it's perfectly normal for it to pull back. Here's a pullback here, didn't quite even get to the 21. We had one close below the 8 EMA. On the other hand, it is in that O'Neill take profit area of plus 20 to plus 25% out of the base. So may just be time for it to build that new base, cash your chips in, and look for something else. Okay, so those were 4 that lagged. How about a couple that might be coming to the fore? FCX and copper. We've talked on our podcast. Mike has gone through copper in depth. He knows the sector like the back of his hand, and he's been waiting for this. Big move up. In fact, look at the 2 blue bars that preceded, in fact, the 3 big blue bars that preceded today's big gap up out of this congestion area. Copper up 7.1%. Mike knows the numbers. There's a big shortage in copper worldwide. There's some copper mines that are, I don't know if they're on strike or they're underproducing or something, but there is a copper shortage issue. And if we're not going into recession and we're going to be, the economy is going to be staying strong, copper is used in so many building components that it's just very clearly something to take a look at. Let's take a look at a couple of copper-related ETFs. COX is copper miners. You can see the gap up there above the 200-day moving average, and CPER, this is the price of copper, gapped up, closed at the bottom of the range, but you really don't want to play CPER because I believe it. Actually, I don't know enough about this ETF, but I would play FCX above copper. So that might be something new. Now, oils have been lagging for a while, but if we're not going into recession, will the globe need more oil than we've been forecasting? They've been cutting production, so maybe we're to the point to where there's not enough supply for the demand. Here's Phillips 66, it's a refiner, probably the best looking oil chart that I saw out there, up 2.3%, breaking out of a flat base. The other oil ETFs don't look that good. Here's OIH, but gap up above the 21. XOP, this is producers, OIH is services. XOP, gap above the 21. A broad one, VDE, gap up above the 21. XLE, this is primarily Exxon and Chevron, gap up above the 21. And we bought NRGU today. This is 10 big oil names. It's a triple leveraged, gap up above the 21. So above the 21 should hold the lows of today. We're up a couple bucks on it, but possible new leadership here. And let's take a look at some other ETFs that didn't that there was rotation in today. So here's the staples, XLP down 1.5%. I mentioned that. Do you need staples if there's not? Staples are usually better in when the economy's not so good. So XLP down, and it could be just a one-day thing at the 200-day moving average here, but we did see the rotation today very clearly. Banks, on the other hand, KRE, big gap up, KBE, that regional banks and big banks, big gap up. So financials definitely have been showing relative strength and added to it today. So oils, big banks, industrials, XLI, gap out of a big base here led by Caterpillar. Huge move today on Caterpillar. And again, if we're going to be building, we need these Caterpillar heavy equipment. So this is the type of rotation that we saw today. Let's get to the portfolio first of all. LYV, Mike knows this story like the back of his hand too. And they got a favorable ruling. There was some regulatory overhang about fees related to Ticketmaster. That went away last week. We got up to 90, pulled back yesterday. Look at the buying volume here, 2 days. And then today they got an upgrade from Morgan Stanley, broke out above this 90 level. We took a position in this today, a starter position. ITB just ridiculously extended. We did our final as I said, 50% gain on that last piece of nail that we had. Just expecting a pullback here and looking to re-enter. NRGU, we added to ESTC. Normal pullback as long as it held the 8 EMA. Let's go through the portfolio pretty quickly here. Path, starter position in this, broke above the 25 level. That looks good. AMD, I'm going from lowest size to biggest size here. Poked its head above 140. This needs to go sideways for a little bit. IoT down today, but not breaking any rules that would trigger us to sell it. GitLab, big move higher the last 5 days up in a row, so it's due to rest a little bit. NVIDIA, not showing relative strength, but holding the 21-day exponential moving average. Coin had a strong day today, making higher highs above that 150 level. CCJ gapped down and had a great recovery today, outside positive reversal, under the 21-day moving average to new closing highs. How about that? We'll take that. ESTC, I showed Snow. These next two are our two largest positions. Snow breaking above the 200 level today, and CrowdStrike gapped up, pulled back, still held the 250 level, still holding the 8 EMA. That's going to wrap it. As always, like to hear from you. The email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, my partner Dan Stewart is at dan@revereasset.com. Like and subscribe on YouTube. Feel free to leave a comment. We reply to all of them. And with that, I'm going to wrap up the video for Thursday, December 14th. This is Don Vandenbord with Revere Asset Management. Just the facts here at Revere, telling it like it is. And right now we're in a bull market. Thanks for listening and have a great day.